Mid-cap funds have been the talk of the town in recent times. So, in today's video, we'll do a detailed analysis of one more mid-cap fund, which is having the highest AUM in its category, that is HDFC Mid-Cap Opportunities Fund, and see whether is this fund still the best performing mid-cap fund and should one invest in this fund or not. Earlier also, I had made a video on this fund in June of 2023. Link is attached in the I button and in the description. Hello everyone, I am Dhaval and welcome to my channel DIY Finance. Let's start the video with the basic details of this fund. First, the AUM, that is the total asset under management, which is more than 59,000 crores, which is highest in its category, while the expense ratio is 0.78%, which is at par when compared to other schemes in the category. The benchmark index, that is the reference against which the scheme is compared, is Nifty Midcap 150 TRI. Now let's look at the fund's trailing returns. From the table, it is quite evident that the fund's performance has been quite good in long term as well as in the short term and is able to beat its category and the index for all the time frames. But as always, trailing returns do not provide a true picture of fund's performance. So let's check the calendar returns and see how the fund is consistent in its performance. Here we have the data from 2014 to 2023. That is last 10 years. And in this 10 years period, the fund is able to beat its index 5 out of 10 times, whereas its category 4 out of 10 times. Hence, we can say that the fund is not that consistent in its performance. Now let's also check the fund's performance for this calendar year. Here we have the data for the first 2 months of 2024 and fund is able to beat its index and the category marginally, which indicates a positive start for the fund in 2024. Hope this outperformance continues in coming months also. Now let's also quickly check the rolling returns. Here we have rolling returns data for 1 year, 3 year and 5 years. If we observe the 1 year rolling returns, the fund is able to beat its benchmark 82% of times with a negative return chance of 16% and an average return of 24.93%. Now let's see the 3 year rolling returns. Here, if you observe, the fund is able to beat its benchmark almost 100% of times with an average return of 19.47%. Now finally, let's look at 5 year rolling returns. Here, the fund is able to beat its benchmark 100% of times with an average return of 16.31% and with no negative returns. Hence, from the rolling returns data, we can conclude that the fund's rolling returns are quite good. And with an investment horizon of 5 years and more, there is no chance for negative returns. From the past performance data, what we have seen till now, the trailing return data is quite good, whereas the calendar returns are not that consistent, whereas the rolling returns data provide a good picture of the fund's performance. So, should we continue our investment in this fund or should stop our investment? But always keep in mind that past performance data is not always an indicator for a future performance. So now let's see what we can expect from this fund in coming times. For that, we'll look at the fund managers and we'll also do a detailed analysis of the fund's portfolio. Firstly, let's look at the fund manager. Mr. Chirag Setalwad has been managing this scheme from January of 2013, that is, from the inception of the scheme, which is a positive for a fund. The fund has performed decent in the past 10 years under him, and so we can expect the same performance in coming times also. Now let's look at the fund's portfolio and we'll start with its sector-wise allocation. Here in the graph, if you observe, highest weightage is given to financial sector, which is around 23%, followed by capital goods with around 13%, whereas healthcare sector is having a weightage of around 11%, followed by technology sector with 8%. Right now, the portfolio seems financial sector heavy, and with such type of portfolio, there is always a chance of sector concentration risk. When we compare the sector allocation with the category, the allocation is quite different except for the healthcare sector. Now let's look at the top holdings and portfolio allocation. Federal Bank, Indian Bank and Max Financial Services are the main stocks of the financial sector. Max Healthcare is the main stock of healthcare sector. Coforge and Persistent Systems are the main stocks of the technology sector, whereas Indian Hotels from the service sector has the highest weightage of around 4%. Now let's check the portfolio allocation. Here if you observe, mid-cap stocks form around 65% of the portfolio, whereas large cap stocks form other 14% of the portfolio, and rest 15% is allocated to small cap stocks. The portfolio is diversified with 68 stocks, and top 10 stocks form around 31% of the portfolio, whereas top 3 sectors form around 47% of the portfolio, where financial sector itself is around 23%. Hence, there seems a sector concentration. The portfolio PE and PB ratios suggest the fund has more growth stocks in its portfolio. So from the portfolio overview and its data, we can say that the fund is following a growth style of investing with a turnover ratio of around 20%. The stock selection also seems good. So before concluding what investors should do, let's quickly look at the risk parameters of the fund. Here, we compare the parameters with the benchmark index and the category average. First one, mean returns. That is the average return in a year, which is 27.51, which is higher than both the category and the benchmark index. Here, higher the value is better. Second, standard deviation. That is a tool to measure how much the returns have deviated away from the mean returns, which in this case is 13.01, which is less than the category average and the benchmark index. Here, lower the value is better. Third one, Sharpe ratio. That is a tool to measure the risk-adjusted return, which is 1.73, which is more than both the benchmark index and the category average. Here, higher the value is better. Fourth one, beta. That is the volatility of the scheme compared to the benchmark, which is 0.89, which is less than the category average. Here, lower the value is better. Fifth one, alpha. That is a tool that measures how much better the fund has performed compared to the category. Here it is 4.38, which is higher than the category average. Here, higher the value is better. From the risk parameters, it can be concluded that the fund is able to generate better returns than its benchmark and the category with lesser volatility, which is quite good for a fund. Now let's see the upside and downside capture ratios. The upside capture ratio is the measure of how the fund performed relative to the index during the period when the index rose. Here, the value is 98, which indicates that the fund underperformed 2% more than the index during the rise period. Here, higher the value is better and should generally be more than 100. The downside capture ratio is the measure of how the fund performed relative to the index during the period when the index has dropped. Here, the value is 86, which indicates that the fund declined 86% as compared to the index during the fall period. Here, the lower the value is better. The upside and downside capture ratios are not that great, which suggests that the fund has an average performance and there are less chances of huge outperformance in the bull or bear phase of the market. So now coming to the conclusion, what investors should do. But before concluding this video and suggest what investors should do, I would request all of you that as you have watched this video till now, it seems that the topic is of your interest. Hence, I would request all of you to hit the like button and also subscribe to my channel if you have not done till now to watch such interesting videos in future also. Here, I would like to clarify that this is not a buy or a sell recommendation and one should take decision by himself or after consulting his or her financial advisor. This video I have made for educational purpose only and my aim is solely to provide the real insight into funds data. Please do not mistake this as a buy or a sell recommendation. So now let's look what investors should do. First, the existing investors. The fund's performance has been good, but is not that consistent and outperformance is also not very large. But overall, if you see the data, the fund seems to be a decent fund. Hence, the existing investors can continue their investment in this fund. It is having the highest AUM in the mid-cap category, but this should not be a concern as quite a few funds have proved that high AUM is not always a constraint for the fund's performance. What do you feel? Do you have this fund in your portfolio? Do share your views in the comment box. Second, new investors. This has been a good performing fund and also comes from a reputed fund house. So one can start his investment in this fund if you are happy with the fund's performance. You can also look at other funds from mid-cap category like Motilal Oswal, Mahindra Manulife, Nippon and Quant Fund House. This is my personal opinion and I may be wrong also in coming times. So what do you feel? Please feel free to share your opinion in the comment section. Would love to know your views on this fund. I would like to add that presently I do not have HDFC Midcap Opportunities Fund in my portfolio and is not planning to add this in near future also. I will again try to review this fund after 6 to 7 months and check its performance. So stay tuned to my channel. Please subscribe to my channel if you have not done till now and also press the like button. Do check my older videos. Click the attached cards to watch the videos. Thank you and see you again in my next video.